Hi, in this session we'll go through a topic of capital budgeting. Capital budgeting is one of the key responsibilities of finance managers and CFOs. While this is very relevant to the finance community, it is equally beneficial for operational managers to understand some of these concepts. So what is capital budgeting? Many of you are involved with projects. Capital budgeting is a process of analyzing projects and recommending which ones to proceed with. Examples: if you are David Jones, which is a retail chain, one of the capital decisions you may be facing is whether the company should open a new store. If you are BHP, one of the largest mining company, you may be contemplating whether to expand the iron ore business in Western Australia. Organizations, whether large or small, public or private, face these very decisions every day. After all, a key purpose of an organization is to grow shareholders' value. Through the choice of projects, value can grow or be destroyed. Net present value is based on this very important finance principle called time value of money. In very simple terms, time value of money reflects the notion that $1 today is worth more than $1 tomorrow. This is because money has an opportunity cost. For example, it can be invested and earning interest. When analyzing projects using NPV, the timing of cash flows is critical. It can have significant impact on the value of the project. Imagine you have to invest $1 million today in a new machinery, but you're not expected to start receiving revenue from this machine for another 5 years. Even though you might generate $10 million from this project, because of the timing of the cash flows, this may not be a sensible project. The golden rule using NPV technique is that if the NPV is greater than 0, then the project should proceed. This is because the project will add value to the organization. Conversely, if the project is negative NPV, it will destroy value. Here are 5 steps involved in working out the NPV of a project. Step 1. Determine the cash flows associated with a project. This includes the cash inflows and cash outflows. Step 2. Work out the time period to be analyzed. Step 3. Select an appropriate discount rate. We'll have another recording to explain the concept of discount rate in more detail. Step 4. Compute the discounted cash flows. This is about using the cash flows in step 1 and discounting them, applying this concept of time value of money. We then aggregate the discounted cash flows across all the years, including the initial investment, to arrive at the NPV. Let's have a look at an example. Here, we are provided with some of the financials of an organization. It shows revenue, it shows the costs, and it shows the profit numbers. This example also has tax, which is typically a cash item to be considered. Important to note that when calculating NPV, one should only focus on cash items. Depreciation is not a cash item. Hence, it is excluded from the NPV calculation. In this example, because we are starting with a net income, which includes depreciation, to get to the cash flow, we are adding back the depreciation of $4 million a year. In working through the financials, starting with net income, we adjust for depreciation, the initial capital investment, and any working capital requirements to derive the free cash flow. Now that we have the free cash flow number, we use the discount rate to discount the cash flows. In this example, we are given the discount rate to be 7%. We have another video which goes through the concept of discount rate. In summary, the discount rate accounts for time value of money, and it represents the opportunity cost for the firm. The discounted cash flows can be calculated manually the long way, as per the formula shown. That is, you take the cash flow, you then divide it by 1 plus the discount rate to the power of n being time. For example, in year 2, you take 8,200, you divide it by 1 plus 0.07 to the power of 2, which gives you 7,162. In year 3, you take 8,200, divide by 1.07 to the power of 3, because it's in the third year. Alternatively, you can use a software like Microsoft Excel to compute the discounted cash flows. Once you have all the discounted cash flows, aggregate them, including the cash outflow from year 0, which is the initial investment. The aggregation of the discounted cash flows gives you the net present value. In this example, it is positive 27 million. Therefore, the recommendation should be to invest in the project. With NPV, it is very common for organizations to provide a range of outcomes. Some of the assumptions require estimation. Therefore, a range of NPVs can be useful in understanding the different sensitivities. Here, in this example, we have done 3 cases: the base case assumption, a best case scenario, and a worst case scenario. You can see from the NPV using these parameters can range from minus 20 mil to plus 126 mil. Sensitivities can also be run on individual parameters such as initial cost of investment, discount rate, costs, and others. NPV is a very powerful technique to evaluate projects. However, there are some common issues with NPV which need to be considered. For example, the cash flow estimation needs to be robust. We need to ensure sunk costs are excluded. Only incremental cash flows are considered. Are the cash flows pre or post-tax? How about working capital requirements? Have they been considered? A common issue with NPV is inconsistency in real versus nominal terms. Are all cash flows in nominal terms? Does a discount rate reflect a nominal discount rate? NPV is also not appropriate in situations where projects are of compliance nature. Being a financial calculation, it also doesn't consider non-financial factors like ESG impact. NPV doesn't handle competing projects which have different lives very well. Despite all of these issues, NPV is very commonly used in the business world. Thank you for watching the recording on capital budgeting focusing on NPV. I trust you have found this very valuable. Any feedback, please do not hesitate to reach out to us. Thank you.